Should you be buying Treasury bonds, notes, or bills? Should you be buying Treasuries in general is a good question. We're going to answer all of these today, as it's not been a better time to be buying Treasuries in the last decade plus, as interest rates across the curve from 1 month all the way out to 30 years are as high as they've been in the last decade. Most interest rates right now at their highs going back to 2007. And obviously as rates and yields ascend, the attractiveness of an investment that's based off of that interest rate or yield increases as well. But first things first, let's get the nuance out of the way, because a lot of people will use bills, notes, bonds interchangeably. A lot of people just say bonds. And while that might work for the corporate debt market, when we're talking about Treasuries, which are considered risk-free, guaranteed by the U.S. Treasury Department and the U.S. government, bonds, notes, and bills do differ, and that's in their duration. Technically, bonds are only speaking to 20 and 30-year duration debt instruments from the U.S. Treasury. Notes, 2 to 10 years. In bills, you can think of as anything a year and under, and that duration is going to be really important because the yield that you're going to get differs from 1 month to 30 years. Conceptually, theoretically, you should be getting a higher interest rate annualized for a 30-year bond, because you're willing to say, hey, government, here's $1,000 for the next 30 years. You would expect a interest rate, a yield on that 30-year locked up capital that's higher than, hey, here's $1,000 for the next month. Pay it back to me in a month. That hasn't been the case recently, which we'll speak to, but I don't want to get too stuck on the recent case because we're in a little bit of a weird time. What is to be sure is that yields in general are high. Historically speaking, we haven't seen interest rates as high as they are now since 2007. And in some of these cases, you look at the 1 month yield up there near 6%. It touched 6% for a brief moment. The highest that you can get in yields on 1 month Treasuries going back to the early 2000s there, even before 2007. And right now, you see that red line and that green line, the 10-year and 30-year, they've been climbing up to close to 5% as well. And that's the first time that they've gotten to that level, like I say, since 2007. And so Treasury is becoming more attractive, especially relative to the environment between 2008 and 2016. All those interest rates, for the most part, especially short-term interest rates in the 1 month to 2 year range, essentially zero. If you want to give the government money for 2 years at essentially 0% interest rate, not a lot of people were doing that at the time. And then, of course, after the pandemic, interest rates were lowered drastically, not as attractive as an investment. But now, as everything is right around 5% or even higher, a lot of people looking at buying Treasury bills, notes, and bonds. Here is your current yield curve. And again, it's an inverted one right now. Normally, you get a higher yield for the greater duration, but it does raise an interesting conversation here, specifically given this inverted yield curve. Should I be buying the 1 month and 6 month? I get a higher yield there. Why would I lock up money for 5 years, 10 years, or 30 years at a lower yield? I got to lock up the money for longer, and I'm getting a lower yield. Well, of course, that becomes a bad trade if in the next year or even 2 years or even 5 years, or if you were looking at 10s and 30s in the next 10 years, if 1 month, 6 month, 1 year interest rates drop at any point during that period, and then also 5s and 10s and 30s drop as well, you missed that higher interest rate for longer, because obviously if 1 month goes from 5.6% to 1% over the course of the next year, then you only got that interest rate on a 1 month basis for a year. So we'll get into that in a second, but you can see here how yields differ with duration. Usually in a normal environment, it's 1 month gets you, let's say, 2%, 6 months gets you 2.5%, 1 year 3%, and so on and so forth, up to 5 or 6% has been the case over the course of the last 10 or so years. Another thing to keep in mind is how these payments are structured. With notes and bonds, it's pretty much the same. You give the government an amount of money, and they give you interest payments twice a year, semi-annual interest payments. So if I'm getting 5% on my $1,000, then they're going to give me $25 halfway through the year and another 25 at the end, effectively 5%. And they're going to do that every year until it comes due. And then they're going to give me my initial investment completely back. Bills are a little different since they're so short term. They actually don't make any payment. If you are, say, giving $1,000 for a 1 year, 12-month T-bill, they'll actually just give you $950, or you'll give them, $950. They'll give you $1,000 at the end of the year. And so the structure of that is slightly different. Either way, you're getting that interest either paid out at expiration in the case of a bill, or in notes and bonds, they're making those interest payments. Now let's get to here. You can decide for yourself at this point if Treasuries are worth the investment at 4, 4.5, 5%, and even beyond with Treasury bills at this point. But now the question becomes, which should you buy? You understand the nuances of how the interest payments are paid out and how the duration structure works. If I buy a 5-year Treasury note, it's locked up for 5 years. But as I alluded to earlier, this becomes a really interesting question, especially in the current environment. Because in most other environments, if it's a normal sloping yield curve, then you get paid for the amount of time your money's locked up. And it's more of a personal question of like, am I going to need this money in the next year? Then I'm probably buying Treasury bills. Am I not going to look at this money for the next 30 years? Then why don't I just get that higher rate for 30 years? Question's a little more nuanced as it is currently, because you can say to yourself, well, I'd be stupid not to just buy the 1 month and get 5.6% and roll it out, get 5.6% for the next 30 years. And anyone who bought a 30-year is an idiot at 4.9%. But keep in mind that if interest rates fall, there's some kind of, economic fear enters the market. The central bank lowers interest rates for whatever reason. Interest rates fall, as they've been known to in the past. You would expect short-term interest rates to get hit the hardest. And so say interest rates fall in 2 years from now, and you've been getting that 5.6% on a monthly basis. You've been rolling out. And then in 2 years, they fall. And now the 1 month interest rate is 1%, and the 5-year, 10-year, and 30-year are 2 or 3%. Well, you could have locked in 4.7 or 4.9% for the next 10 or 30 years, as opposed to now you've got that higher interest rate, but just for a short period of time. And when you go to roll it out, now I'm only getting 1%. So definitely a conversation strategically for you out there as well. Maybe diversification could be a good thing in instances like this, very similar to, should I buy the high-flying tech stocks, or should I buy companies that have been around forever, like a Disney or what have you, that I can be confident will probably be around in the next 20, 30 years? Well, you could do both, right? You can have whatever your investment capital is, take advantage of those higher short-term yields and roll that money out in time, and also buy a 5-year or a 10-year or a 30-year note and have that to lean against, to be like, okay, if interest rates ever fall, I got some up near 5% for the long term. So a really interesting time to be investing in Treasuries. You've got the differences between bills, notes, and bonds, and also some of the strategic nuance given our current inverted yield curve.